The United States enters 2026 carrying more than $34 trillion in federal debt. That's over 120% of GDP. Economists call it unsustainable. Politicians call it a threat. Markets? They shrug, at least for now. America borrows openly, constantly, and expensively. Elections revolve around it. Ratings agencies' downgrades spark headlines. Bills stall in Congress over spending fights. It is chaotic. It is messy, but it is transparent. Every U.S. Treasury bond is tracked. Investors voluntarily buy them. And the U.S. dollar remains the world reserve currency, the bedrock of global finance. Printing dollars carries risk. But in crisis, investors still run toward the U.S., not away from it. Yet America has real vulnerabilities in 2026. Rising interest costs, eating federal budgets, political gridlock overspending, declining trust in institutions, slowing immigration growth versus aging population. Higher borrowing costs than major peers. America's debt problem is like a loud alarm in a house full of people. Everyone hears it. Everyone argues about it. Someone eventually fixes something because the whole world is watching. China debt behind a curtain across the Pacific. China tells a calmer story. Official debt under 90% of GDP. Low government bond yields. Strong credit rating. Stable narrative, but that's the surface. Beneath it lies trillions in shadow debt. Local government financing via vehicles state-owned. Enterprise debt. Hidden municipal loans. Real estate developer liabilities. Off-balance sheet. Banking exposure estimates suggest China's real debt could be 300%, 400% of GDP, quietly rivaling or even exceeding America's. The machinery that drove China's miracle, infrastructure, housing, rapid industrial growth, was powered by credit. Not magic. Entire ghost cities built on borrowed money. Developers like Evergrande collapsing under hundreds of billions. Local governments rolling debt forward permanently. And unlike the U.S., China's debt isn't priced by markets. It's controlled. Capital controls prevent sell-offs. State banks buy government debt by instruction, not choice. Confidence is manufactured, not tested. It works while growth is strong. It works while trust is high. It works while people believe tomorrow will be better than today. But what happens when that belief cracks? In America, housing cycles crash and recover. In China, property wasn't a cycle, it was the engine. For decades, buying property was the retirement plan. It was a culture, a North Star of wealth. Now prices fall, projects sit unfinished, youth delay marriage and home buying, developers default households. Hoard cash. 70% of China's household wealth sits in real estate. And deflation turns assets into anchors. Debt is manageable when values rise. Debt becomes suffocating when values sink. Both nations are aging, but differently. America in 2026. Young workforce via immigration technology-driven productivity gains consumer-driven economy. China. In 2026, shrinking labor force, rapidly aging population, low birth rates, youth unemployment pressure, consumer caution. Not confidence. Demographics don't cause crises suddenly. They quietly erode strength, year by year, policy by policy. And in China, fewer workers, fewer births, and fewer buyers mean less growth to outrun debt. So who's really at risk in 2026? The U.S. faces political paralysis, rising borrowing costs, deficit addiction, dependence on foreign buyers for treasuries. China faces hidden leverage, real estate contraction, local government insolvency risks, confidence erosion, deflationary drag, limited demographic. Relief. America's risk is fiscal chaos out in the open. China's risk is an invisible fracture that may suddenly surface. The U.S. system bends loudly. China's system does not bend until it breaks. What it means for the world if America struggles. Markets shake. The dollar rises. Borrowing costs spike globally. If China stumbles, supply chains freeze, commodity markets crash, emerging economies suffer, and global growth contracts. Each crisis would be global, but China's would be quieter, deeper, harder to see coming. Final thought. The question isn't who has debt. Both giants do. The question is who can survive it. America's strength is transparency, scale, and market trust. China's strength is control, coordination, and long-term planning. America's weakness is politics. China's weakness is opacity. 2026 won't give us the final answer. But one truth is clear. Debt becomes dangerous not when it grows, but when confidence disappears. And confidence, in governments, in markets, in tomorrow, is the real currency that decides who wins the future.